You open your brokerage app and find the screen covered in red. Some of the strongest tech companies are plummeting, down 20% in hours. The immediate reaction is to hit the panic button. You have to decide right in that moment whether the broader economy is cracking or if you're looking at a rare systemic window to buy. Usually, this anxiety kicks off with macroeconomic pressure. A looming CPI report or an upcoming Federal Reserve rate decision starts making Wall Street nervous, creating the initial wave of fear. This chart illustrates what's actually driving those sudden pullbacks. It's a mechanical process called institutional capital rotation. Major financial institutions constantly need to free up massive amounts of cash to prepare for major market events, like highly anticipated upcoming IPOs. To get that cash, they have to liquidate. They aggressively sell off their profitable existing tech positions to build a war chest. That mass institutional sell-off is the exact mechanism causing the 5 to 20% price drops you see on your screen. This hunt for liquidity doesn't stop at tech stocks. It bleeds directly into alternative assets like Bitcoin, as funds extract cash from anywhere they can. Trying to time the exact bottom of this sell-off is a trap. If you wait for the perfect entry point, you usually miss the consolidation period and the inevitable rebound that follows. Recognizing that this is a mechanical capital rotation rather than a structural collapse transforms a red day into a strategic window to acquire strong assets at a discount. Knowing why the market is down is only the first step. The next is figuring out exactly where to deploy your cash based on how much risk you can stomach. For this specific pullback, Broadcom, ticker symbol AVGO, stands out as a premier AI infrastructure play. Broadcom provides the critical hardware and networking architecture that physically allows the global AI boom to function. They are the plumbing of the entire system. This quadrant chart maps our options. We are measuring volatility on the bottom axis against established stability on the vertical axis. Broadcom lands firmly in the upper left quadrant. It offers the high stability of a mega-cap company, combined with relatively moderate volatility. But it carries a specific downside. Because it provides AI infrastructure, its stock price is heavily tethered to the broader sentiment of the entire AI sector. That means external events, like the earnings reports of its peers, can send sudden, unpredictable shockwaves through Broadcom's valuation. The primary driver of that momentum is NVIDIA. When Jensen Huang makes a move or announces earnings, the ripple effects directly dictate the direction of the entire hardware sector. Geopolitical shifts and international trade policies further amplify these sector-wide swings, making the entire space extremely sensitive to macro news. Capturing the upside of a Broadcom dip requires holding firm over the long term. You have to be willing to sit through those news-driven industry shockwaves without selling your position. Shifting focus to the digital software layer offers a completely different setup, specifically software-as-a-service companies. Salesforce, or CRM, is the archetypal beaten-down SaaS giant right now. It is currently trading at a deep value discount. Let's bring our risk framework back up to see how the software play compares. Salesforce lands near dead center. You are acquiring safe, established cash flow, but you are trading away explosive upside for a much slower, grinding trajectory compared to the hardware giants. That steady software approach sits in sharp contrast to the extreme risk found in digital compute and energy sectors. This is where a company like Iris Energy, ticker symbol IREN, enters the picture. It is a high beta, small cap play on data centers and cryptocurrency mining. The upside potential comes from compounding demand. Iris Energy capitalizes on the skyrocketing power requirements of both AI processing and Bitcoin mining simultaneously. But look at the chart. Iris Energy drops into the extreme bottom right corner. It carries low stability and massive volatility. With this level of extreme beta, you must be mentally and financially prepared to stomach a 20% drop in a single trading session. If you have a short-term time horizon or a low tolerance for rapid drawdowns, this type of compute play has absolutely no place in your portfolio. Stock selection is entirely subjective. Your capital allocation has to perfectly mirror your own personal stomach for violent price swings. Executing a successful buy-the-dip strategy means matching those three very different assets to the specific investor profile you fit into. This decisional scorecard helps you map out your choices based on target ticker, time horizon, and volatility risk. We start with the foundation builder. This is the investor who prioritizes enduring technological shifts over making overnight wealth. Broadcom maps directly to this profile. It provides steady, compounding growth with a long-term horizon and moderate risk, letting you sleep at night. Next is the value hunter. This investor looks to capitalize on market overreactions by buying cheap, reliable cash flows. Salesforce belongs here. You will have to endure the frustration of watching other sectors rally while you wait for capital to rotate back to software over a mid to long horizon. Finally, we have the speculative optimizer. This is a high-risk investor strictly hunting for asymmetric upside. Iris Energy is mapped here. It offers the massive potential rewards of the compute and energy sectors, but comes with extreme volatility over a short to mid timeframe. If you take this path, you must actively manage your position sizes. Overextending here can lead to total portfolio devastation during a macro downturn. Ultimately, investing is a constant balancing act between potential reward and acceptable ruin. Market mastery belongs to those who execute targeted strikes that align perfectly with their unique financial architecture.